Good morning and welcome to today's webcast, Balance Sheet Management. I'm happy to introduce today's speaker, Jennifer Rabanal, partner at Moss Adams. Jennifer is located in our Napa office and has over 25 years of public accounting experience, focused almost entirely in the wine industry. Prior to joining Moss Adams, she had her own firm for nearly 9 years where she performed audits, reviews, compilations, financial forecasts, and consulting services for industry members. Jennifer is a graduate of UCSB and is a member of the California Society of CPAs and the American Institute of CPAs. She serves on the Finance Committee for the Napa Valley Grape Growers Association and is also a member of Women for Wine Sense and has served as CFO and treasurer of its national board. Before we get started today, I'd like to remind everyone that we will save time at the end of the presentation for Q&A. If you have a question, please type your question in the Q&A window to the left of the slide view and click Submit. Jennifer, I will now turn the line over to you to get us started.
Thank you, Emily, and thanks to everyone for joining the call this morning to hear about balance sheet management. Many business owners focus more attention on their income statement than they do their balance sheet. They want to know, how profitable am I? But as you have likely experienced, your income statement may show you made a profit, yet you are wondering, where did all the money go? This is especially true in the wine industry, as it takes up to several years to produce a bottle of wine, incurring costs all along the way. What you're selling today, the cost that's hitting your income statement, but much of that cost was incurred a few years ago. So why are balance sheets important, and what is the goal of balance sheet management? Balance sheets are important because they keep you informed of your company's financial standing. They can provide indicators of potential financial trouble. The goal of balance sheet management is timely, logical, and comprehensive decision-making, resulting in efficient operating profitability. In short, this means targeted action to manage to planned or expected results. So let's start with what a balance sheet is. The balance sheet is a snapshot in time. It represents the financial position of a company as of a specific date, with assets on one side and liabilities and owner's equity on the other, and the two must equal or balance. It represents a certain point in time. However, we can look at the balance sheet from three perspectives. The past can provide data points on expected ranges and allow comparison between years. During stable economic times, the past can provide some help in peering into the future. The present is a representation of where the company is today. How much cash do we have? What do our customers owe us, and what are our debts? Knowing one's current condition is the starting point on the path to your chosen objectives. Development of an action plan is also easier when you know where you're starting from. You can't draw a map to your destination if you don't know where you are. The third perspective is the future. By projecting out what you think is likely to happen, you can use it for making decisions today and to monitor actual results against that plan on a periodic basis going forward. So when looking at the balance sheet from a past, present, and future perspective, some strategies emerge. You can mine the past, specifically digging into financial and non-financial data. Your historical accounting data should be readily available and is inexpensive and can provide valuable information. The past can help provide perspective when answering the following question: where am I today? Am I in a better financial position than I was 5 years ago? Developing a plan of action starts with a true self-assessment of where you are today. Without it, conceptualizing how to get where you want to go is difficult. Crunching the numbers on the following can assist in understanding where you are today. Although there are numerous key metrics for balance sheet management, these are likely in the top 10 for wineries: balance sheet line item reviews, working capital, inventory turn, and debt management. And we'll look at each of these a little bit more later. Market-based forecasting is another strategy. Notice I didn't say historical forecasting. Although the past can suggest likely ranges of outcomes that may occur in the future, forecasting based on expected market condition is preferred. Once a market-based forecast is developed, including a balance sheet, ratios and relationships can be compared to historical records, thus ensuring expectations are within acceptable ranges. For balance sheet management, the tools are simple: financial and non-financial data. And financial data can represent an account balance, an average cost, or other accounting activity. Examples of non-financial data include tons harvested, number of acres, or cases produced. Another key for balance sheet management is a forecasting model. It's important that the model is easy to use, and most of my clients just use an Excel-based template, which is quite adequate for this purpose. Lastly, effort will be required to create, implement, review, and update both the financial and non-financial data. Reporting efforts will be needed on a periodic basis to accumulate relevant information. Some might create a dashboard that summarizes key information, balances, and ratios. And then monitoring is important. Once the reporting is complete, someone of an appropriate level, like a decision maker, should be monitoring actual results with predetermined expectations. It shouldn't be anything too complex, otherwise it is more likely to accumulate dust than to provide benefit. Looking back on prior results can provide perspective on the present day and reasonable ranges for forecasting. This slide shows a list of possible ratios and relationships that could be tracked. Pick the ones that have the pulse of your business. If you're trying to control wine costs, you might want to track production costs per gallon, overhead per gallon, or bottling costs per case. If cash flow is really tight, average days in accounts receivable and accounts payable and inventory turn might be important. You may also have loan covenants requiring minimum or maximum ratios, so those would be important to track as well. You should track multiple years, as that gives you a basis for seeing trends. And comparability is very important. You want to make sure that you're comparing apples to apples year over year. Keep notes from the past to highlight any anomalies, like a very large harvest, because that might distort the trends. So what do you do with these ratios? Well, they can be used for monitoring. As I mentioned on the previous slide, monitoring is one of the key tools in managing your balance sheet. You can see if you're getting off track. Are your receivable days lengthening? There could be issues with collections. So let's take a look at some ratios and relationships. As I mentioned earlier, certain ratios and relationships are often considered more critical to the health of a winery's balance sheet, like working capital or inventory turn. Here's an example including 3 periods, beginning with the earliest, which includes ratios and financial category which they describe. The working capital and related current and quick ratio provide data points on a company's liquidity, which highlights the company's ability to pay short-term obligations. Current ratio is calculated as current assets divided by current liabilities. The quick ratio is cash plus accounts receivable divided by current liabilities and is a more conservative estimate of liquidity. Working capital is current assets minus current liabilities. You want to have enough working capital to fund operations for several months. Now, current assets are defined as assets reasonably expected to be converted into cash within 1 year. What's unique in the wine industry that inventory is considered a current asset, even though the production cycle for most wines exceeds 1 year. Moving on, solvency is the company's ability to meet its long-term financial obligations. It's essential to stay in business. These ratios include debt to equity, in other words, how leveraged you are, or also known as your leverage ratio, and tangible assets to equity. Because the wine industry is so capital intensive, wineries are typically more leveraged than other businesses. For the operating ratios, I've chosen to highlight the number of days certain balance sheet line items tie up cash. In order to calculate each of these, you will need 2 balance sheets and the income statement for the period between those balance sheet dates. For example, accounts receivable turn, which measures how many times accounts receivable is collected per year, is calculated by dividing your credit sales by the average accounts receivable balance for that period. To determine the average days in accounts receivable, you would divide 365 by that result. Inventory turn and average days in inventory is calculated similarly, but using cost of goods sold and average inventory balances instead of sales and accounts receivable. The capital-intensive nature of the wine business places a premium on cash. Changes in inventory, accounts receivable, and accounts payable balances result in both inflows and outflows of cash. But what may be less apparent is how many days cash is tied up in these accounts. Even less apparent is how many days it takes cash to be consumed by payables, absorbed into inventory, sold, and ultimately converted back into cash through collections. In other words, the cash conversion cycle. So in looking at these prior periods, what can history suggest about the future? In some cases, we can expect similar performance or ratios, like we might expect average days in accounts receivable to be around 15, based on the 3 prior periods of 15, 13, and 18. However, in my experience, most wineries' average days in accounts receivable is closer to 30, as that's typically what your terms are. I would also note that in this example, inventory turn is less than a year in most cases. However, for most wineries, it would be at least a year, or typically 2 years or even longer. Also, don't fall into the trap of forecasting based primarily on historical data points. Forward-looking market-based assumptions are better. Evaluating what do you expect to happen with sales or production. If you plan to sell off a property or pay down debt, all of these will impact the above ratios. If you expected to produce and sell a lot more Sauv Blanc than Cab, you shouldn't expect your inventory turn to be consistent. You would expect the turn to increase and the average days in inventory to decrease, since Sauv Blanc turns much more quickly than Cab. So I mentioned the cash conversion cycle on the previous page. What does this measure? The cash conversion cycle is one of several measures of management's effectiveness. It is a combination of the operating ratios that we discussed on the previous slide. It's the days in accounts receivable plus days in inventory minus days in accounts payable. It measures how fast a company can convert cash on hand into even more cash on hand. The cash conversion cycle does this by following the cash as it's first converted into inventory and accounts payable, through sales and accounts receivable, and then back into cash. Generally, the lower the number is, the better for the company. For instance, if too much inventory builds up, cash is tied up in goods that can't be sold, which is not good news for the company. In order to move this inventory quickly, management might have to discount, possibly even selling its inventory at a loss. If accounts receivable is poorly handled, it means that the company is having difficulty collecting payment from customers. Accounts receivable is essentially a loan to the customer, so the company loses out when the customers delay payment. The longer a company has to wait to be paid, the longer that money is unavailable for investment elsewhere or to pay down debt. On the other hand, the company benefits by slowing down payment of accounts payable to its suppliers, because that allows the company to make use of the money for longer. Going back to the previous slide, we can see that all of the operating ratios worsened in prior period 1. In other words, the days in accounts receivable and inventory increased over prior period 2, and the days in accounts payable decreased. All of these putting extra strain on cash, so the cash conversion cycle worsened to 351 days compared to 236 days in prior period 2. Now I'd like to switch gears and move into the balance sheet line item reviews, which earlier I mentioned was one of the strategies for evaluating where your business is today. These reviews should be performed on a periodic basis and act as a check-in for each line item on your balance sheet. The length of time needed to review should be linear with its importance. For example, more time should be spent on cash and inventory than prepaids and accruals. This will not be all-inclusive, but will provide things to think about. So let's reflect on the top of the balance sheet, cash, and the competing demands on cash, such as funding operations, growth, capital servicing, and contingency, that rainy day fund. Each of these needs to be accounted for. With numerous items to consider and a long lockup period, a systematic approach to managing cash can help. On the next couple of slides, I will walk through an analysis of managing cash on a periodic basis. This approach is important due to the length of time that cash will be tied up until it's converted back into cash. Think about your own personal finances. If you had some extra cash with which to purchase a CD, would the amount of time you'd be willing to commit to a 30-day CD, amount of money you'd be willing to commit to a 30-day CD be different than a one-year CD? More thought will likely be needed prior to locking up your cash in a one-year CD given the unknowns of the longer period of time. Things to consider might be, am I expecting any major expenses? Do I have enough should something unexpected happen? This is similar to your business, as the cash conversion cycle will typically exceed 1 year for a winery. Let's look at that 5-step example. So in this example, there's 4 periods. The frequency of each period may vary, but monthly would be my suggestion. However, for those companies struggling to maintain available cash flows, increasing the frequency to a weekly basis may work better. How many future periods to consider is also a matter of judgment. At a minimum, a rolling 1-year analysis should be considered, assuming you're looking at monthly periods. So step 1, determine cash flow from operations. In its simplest form, this is cash receipts versus cash outflows. For this example, cash receipts includes cash sales and collections on accounts receivable. For cash outflows, we'll use purchases, accounts payable disbursements, asset purchases, payroll, and debt payments. Calculating each period will provide net cash flows. For example, in period 1, shows $260,000 of cash receipts or inflows and $270,000 of outflows for a net cash outflow of $10,000. Step 2, calculate any surplus or shortfall by period, starting with the cash on hand at the beginning of the period and adjust it for the current period cash flows and calculate the cash on hand at the end of the period. The result will identify shortfalls which will need to be addressed or surpluses which can provide an opportunity for action. Step 3, address the shortfalls. Addressing shortfalls can take a couple of different forms, such as additional borrowing, selling off bulk wine, or contributions from owners. Step 4 might be to fund a contingency pool for any unexpected expenses. And step 5, funding a capital budget or distributing any excess. Again, this is a brief example of a balance sheet review of cash. Continuing with the balance sheet line item review, let's look at inventory. There are numerous potential items to consider when reviewing inventory. This is not meant to be all-inclusive, but examples. You will need to balance the competing desires on inventory. These could include the sales department's desire to have possibly unlimited inventory in both varietals and quantities, and production might want to have unlimited supplies of the best quality, and purchasing may want to maximize discounts through volume purchases. Each of these would create pressure to increase inventory, but that comes with cost. So inventory levels must be maintained in a manner consistent with market-based consumer demands. To help manage these competing demands, I suggest creating a policy addressing overall company objectives, which is communicated to each department. This might include the following elements: the number of varietals or SKUs, the quantities to be produced, and acceptable costs, carrying costs, capital expenditures, material costs, grapes, labor, etc. Then this policy should marry up with the cash flow considerations from the cash review on the previous slides. Use forecasts to help balance supply and demand. The wine production cycle is a long one, and it's difficult to change your ship's direction quickly. Creating a long-range forecast to determine production needs based on projected demands in the marketplace can be critical. This gives you a basis for comparison to determine if your ship is getting off course. The net under or over compared to your sales forecast will provide a data point and perspective on next steps needed to manage inventory levels. Keep in mind, inaccurate sales estimates may pose the most risk of errors in inventory management, meaning an overzealous sales forecast may result in an undesired buildup of inventory. Once you get comfortable that sales and inventory levels are in sync, a review of inventory ratios could come next. You might consider looking at cost per gallon and cost per case in total and by component, like grapes and farming costs, overhead, and/or bottling. After calculation and comparison to prior period or expected results, understanding unusual variances will highlight areas for additional focus or opportunities for improvement. In order to perform the ratio review of bulk and bottled wine, this will require that your inventory is costing on at least the same periodic basis. If costing is only performed annually, the effectiveness of periodic review will be reduced. The frequency of costing is a matter of judgment, and more than annually could be a challenge for most small wineries, but reasonable estimates can be applied until the final cost is determined. Also be sure that the costing methodology is consistently applied and not changed from period to period. Otherwise, the comparison won't be reasonable. So at the heart of inventory balance sheet review is really just answering the following questions. Do I have too much wine? Do I have too little wine? Is it too costly? And am I incurring unnecessary losses? Periodic reviews of cash and inventory on the balance sheet will likely take the most time. I'll comment on the remaining balance sheet line items more quickly. Accounts receivable. Timely billing and collections is important. It's important to look at your accounts receivable turnover ratio, which can highlight any problems with collections. You should also monitor for past due receivables. Review your accounts receivable aging on a regular basis to determine if there are any past due accounts. Other receivables might be related party or employee receivables, which typically aren't significant but are sometimes ignored. So be aware if these are building up on your balance sheet. Prepaids typically are not a significant balance sheet item as well, but again, they are sometimes ignored and you should pay attention to make sure that they are not building up as well. Fixed assets are a significant balance sheet item, but it doesn't require frequent monitoring. It's important to maintain a capital budget and monitor against it. Review your repairs and maintenance costs to make sure they're reasonable and that no capital expenditures are buried in them. Also review and clean up your fixed asset listing. Remove any assets that are no longer in use or existence. And perform a periodic inventory of your property, plant, and equipment. Do a physical count. Make sure nothing's missing. So moving on to the liability side of the balance sheet, we have your line of credit, accounts payable, accruals, and long-term debt. The first three items are short-term in nature. Accounts payable and accounts receivable are typically repaid quickly. While your entire line of credit balance isn't usually expected to be repaid right away, this debt should be used to fund current operations and should be considered a short-term financing solution. You typically shouldn't finance long-term asset purchases with your line of credit, though. Each of the above liabilities should be reflected in the 5-step cash management tracking on the previous slides, as well as be consistent with your inventory policy. Aside from the actual cash flows related to debt, it's important to consider ensuring that your company's capital structure can be supported by operations. If it's overburdened with debts, too leveraged, that debt to equity ratio is too high, the company's sales and collections activities may not provide sufficient cash flows to service its capital structure, and you could be in trouble. So I've talked about the importance of forecasting in order to provide benchmarks for monitoring your balance sheet. In the forecasting process, consider market conditions and use historical data sparingly. Develop a forecast model that works for you and that you understand. As I've mentioned, Excel works just fine. If you're unfamiliar with Excel, work with a trusted advisor to help you develop one. We'll look at an example of one on the next slide. Pick the metrics that have the pulse of your business. Think of them as key economic indicators, something you can glance at and feel comfortable you're still on the path of success. And then use these indicators for monitoring. So here's an example of what a forecasted balance sheet might look like. Of course, this wouldn't be standalone. It would all be linked to your projected sales, production, capital, and operating expenditures, etc. Your model could include certain ratios for evaluation. For example, if your lender requires you to maintain certain working capital or debt-to-equity ratio, you could project where you may have issues in the future years. The forecast would provide you with key data points to use in evaluating your financial position each year relative to plan. If you're projecting inventory to be at a certain level in year 3 and the inventory is double that, why is that? Are sales lower than projected? Did you produce way more, or are your costs just significantly higher? So to kind of wrap things up here, determine your key financial and non-financial metrics to monitor that are important to your business. Review balance sheet line items on a periodic basis, and use a forecast model to provide future benchmarks for comparison. And then monitor your actual results to these benchmarks. And now it looks like we have lots of time for questions. So, Emily, I didn't know if there's any that came through while I was speaking, or
Yeah, we do. We have a few questions that came in. Someone would like to know if you could just review or repeat steps 4 and 5 of the cash management.
Okay, let me find those pages.
And just a reminder, if you have a question, just submit that in the Q&A window.
So step 4 and 5, let me go back to my slides here. I think it was funding a contingency pool was step 4. So if you had excess cash, or you're very risk averse and want to make sure you have enough money set aside, just keeping enough cash reserves, so funding that. And then step 5 was funding any capital budget. If you had big fixed asset expenditures that you were planning, keeping cash aside to fund that, or if you had excess cash, to distribute it to the owners.
Great, thank you. Our next question is, how often should I be reviewing my balance sheet? Monthly, annually?
At least monthly. And certain items you may want to be looking at on a weekly basis. You know, it really depends on how tight your cash is. If cash flow is really tight, you probably want to be looking at things on a weekly basis. Managing those accounts receivable collections, controlling your accounts payable disbursements.
Great, thanks. The next question is, what are the average benchmarks for debt-to-equity ratios, or better yet, how do you determine the average based on my situation? Based on your situation. I'm not sure what that means, but debt-to-equity, I see ranges. You know, wineries, like I mentioned, you're usually quite leveraged, and if you own real property, it's even worse. But you know, over 2.0 is something we see. Up to, I've seen as high as 4.0. Most banks want it closer to 2.5. Okay, thanks. Another question is, what other documents do I need handy to prepare my balance sheet? We need an accounting system. It should all be, your balance sheet should be derived from your accounting system. If you're using QuickBooks, you should be able to produce it. The things you would want to be able to run as well from your system would be like an accounts receivable aging and accounts payable aging, to compare those and make sure that they reconcile. The inventory is always the hardest part, and a lot of small businesses don't have somebody in-house that can
be keeping that up to date. So work with your, if you have a CPA or trusted advisor to help keep your inventory balances updated on a at least quarterly basis, I would suggest.
Thanks. And can you clarify what a reverse accrual is and when or what it should be used for?
A reverse accrual? Is that the question?
Yes.
I'm not sure what they mean by that. An accrual is basically a payable that you aren't running through your accounts payable system. So you're booking that liability, and then reversing that accrual would be removing it from the liability account. And so say when you record an accrual, you would be hitting an expense and booking the liability, and then when you reverse the accrual, typically you've paid that expense, and so it's either hit the expense again, so when you reverse it, it'll reduce the expense. So the net hitting the P&L is the correct amount. You're not double booking the expense, basically.
Thank you. And we have a couple more questions here. What is debt covenants?
Lenders will require certain, there's several different debt covenants, but the financial covenants are typically financial ratios or minimum requirements, like they might require a certain amount of working capital, or you'll typically see a debt service coverage ratio because they want to make sure that you're going to be able to repay them, and that's calculated looking at it's basically trying to look at your cash flow and determine, and then what your current debt obligations are for the next year, and making sure that you're going to be able to pay that from your operations.
Great, thanks.
But each lender has their own covenants, and but most of the ones we see in the wine industry are there may be current ratio, working capital requirements, tangible net worth, and debt service are the main ones.
Okay. And the next question comes from someone in San Diego, and they say, we have a small but expanding wine industry in our county. The wineries aren't owned by .com millionaires. How do upper middle class owners survive in the winery business, given the apparent need for lots of cash?
That's a good question, because you've probably heard, how do you make a small fortune in the wine industry? Start with a large one. It's finding a bank that understands the wine industry is probably a good start. The lenders who deal in the wine industry know that they know the nature, they know the capital intensive nature. If you have assets that they can use as security, that always helps. But yeah, that's a big challenge.
Thank you. And we have time for a few more.
Mm-hmm.
Do I need a land valuation to record it as a tangible asset, or is an estimate enough?
So when your balance sheet, and I should have probably stated this earlier, balance sheets typically reflect your assets at their cost basis, not their fair value. So if you were to, when you acquire a piece of land or building, that goes onto the balance sheet at the cost you pay. It may appreciate, your land value may double in 10 years, but on your balance sheet, it will still be reflected at that original cost. So if you're going to a bank and trying to borrow based on this value, you will probably need an appraiser, and a lot of the banks have their own appraisers they use, but it won't be reflected on the balance sheet at its current market value.
Thank you. Looks like we have a couple more. Where should I allocate trade spending, slotting fees, and promotions?
In accordance with generally accepted accounting principles, those should be net against sales. Special pricing allowances, depletion allowances, those are considered pricing concessions and typically should be reducing your revenues, or a contra revenue, so to speak.
Great. And looks like we have one final question, and they just would like a review of the first 3 steps of cash management.
Okay. Let me go back. I can find the slide. Okay, so you're basically trying to determine your cash coming in, cash going out, and then what cash you have on hand. So the first step is the cash receipts. So you may have true cash collections and then collections on accounts receivable. And then the cash outflows would be everything you're spending, purchases, accounts payable disbursements, any asset purchases, payments related to payroll, and then on your debt service, both the debt and the principal and interest repayments to determine your cash outflows. And then you would have a net number, either a positive or a negative. And then you have your cash balance at the beginning of the period, and then that positive or negative is applied to that cash balance to see where you're going to land at the end of the period. So in this example, in period 1, you're ending with a positive cash balance, and then you can see that cash balance carries over to period 2 as the beginning balance, and then the net cash of $50,000 coming in gives you an ending balance of $60,000 that then carries to the beginning balance of period 3. So it's just a rolling balance of your cash, and then applying the net cash in or out based on your projected inflows and outflows to determine whether you're going to have a shortfalling or a surplus.
All right, thanks for touching on that again. And it looks like we have one final question. Is there such a thing as an intangible, non-depreciable asset in the value of your DTC customer list? And if so, how do I value that customer list?
That's a tough question, but customer lists can have an intangible value, but you can't record it like a self-created intangible. The only way an intangible like that would be recorded would be if it were in a business acquisition. So if a company were to acquire your company, all of the assets and intangible assets are valued, and that customer list potentially has a value that would be assigned to that acquisition. And typically that customer lists are amortized, though they're not. They don't stay on the balance sheet forever because there's the customers eventually are going to leave.
Great. Thank you so much for your answers, Jennifer. And if anyone has any further questions, you can reach out to Jennifer here. Her contact information is on the screen. And I think that's all we had today. So again, thank you, Jennifer, for a great presentation.
Sure. Thanks, everyone, for joining.
Here's a link to an online survey where you can provide feedback for today's presentation. Please take a moment and fill this out, as your feedback is very important to us. And thank you all for joining us, and we hope that you will join us again next time.